Hello, today is September 17th, 2025. Here's the new deep value net stock that I recently uploaded. Name is Winmill & Co. Ticker is WNML. It's a New York-based asset management stock on the OTC ID, which is like bottom middle tier of the OTC market. 820,000 shares held at the DCT. That normally means that it's has some liquidity at least. Market cap is around 5.8 million, depending on which website you're looking at. Share price of $4. No meaningful share dilution. 1.5 million Class A shares authorized. 1.4 million have been issued and are outstanding. And this is from an audited 2024 financial report. Even though on the official OT website it says that there's 10 million that are authorized, which is incorrect. There's 20,000 Class B shares authorized, issued and outstanding. Liquidation value on the stock is 13 million, which makes the stock 56% undervalued, which could be a 127% return. These are the common stocks of publicly traded affiliates that the company holds. Right over here, you can see the value of them for 2025, which is all up here. So all of these are their holdings, and this is the cost basis and the value of them right now for a total of 10.56 million. And then if you go to the assets for this, you see cash and cash equivalents for 2025 is 2.88 million. And if you add these all together, that is about $13 million in liquidation value. So this business has a lot of stakes in affiliates and some fully owned subsidiaries. This is where the majority of the value for this business comes from, right here. So I generally dislike investment management heavy businesses, but this one was so undervalued that it caught my attention. And some of the risks for this business and the most likely outcomes, if you look in the footnotes for this business, it actually says that the Class B shares are the only shares that have voting rights, and the shares that you'd be buying for this business would be Class A. So what that means is the majority of shareholders have little to no say, and they don't get to vote, which means management can vote on whatever they want, and it'd be incredibly hard for activist investors to make meaningful change in the business to unlock value. As it is now, the management only voted on an authorized maximum of 7.1% share dilution. So if they wanted to dilute the shares in the future, they could dilute it by 7.1%, and then they would have to do a vote to dilute more. But that's as much as they can do right now, which is good. So the most likely outcomes for this business is that the business and subsidiaries do average over time, just do about what they're doing now, and earnings don't decline, they just stay the same. Shares are not diluted, book value grows, and share price is drawing closer to liquidation value or net current asset value over time. Second most likely is that the business and subsidiaries don't do well, shares are not diluted, book value slowly shrinks over time, but very slowly. Third most likely, management vote on a merger or acquisition and full liquidation. And full liquidation or net current asset value is realized immediately, which would be 127% return. Fourth, most likely, business and subsidiaries do average over time, and management vote in more shares and compensation structures for themselves, and book value stagnates. Fifth, most likely, is that the business and subsidiaries don't do well over time, and management vote in more shares and compensation structure for themselves, and the book value deteriorates over time. And the sixth and least likely is that the business gets wound up and liquidated, which is very unlikely because the management own all Class B shares, and all Class B shares are what have voting rights, and they would have to vote themselves out of a job, which I find very unlikely. So that's it today for today. If you like the analysis of this kind of classic Ben Graham style stock, subscribe to my channel. Thanks and take care.